Welcome to the Deep Dive, where we take complex, often, intimidating financial topics and try to cut through the noise to deliver pure, actionable strategy.
And today, that noise is louder than ever.
It really is. If you're trying to get into the Canadian real estate market right now, you know what a colossal challenge it is. The costs are just astronomical.
The interest rates, the stress test, it feels less like a safeguard and more like a barrier.
Exactly. A cruel joke designed to keep you out. So our goal today is to give you an operational roadmap, some real shortcuts.
Yeah, and while the landscape is tough, there are tools to help, but they are so often misunderstood or honestly criminally underused.
You found a stat on that, right, for the homebuyers plan?
I did. We looked at the research, and even for a program that's been around for decades, like the HBP, only about 17% of eligible Canadians actually maxed it out in 2023.
17%. So that's 83% of people just leaving powerful tax advantages on the table.
They are. And it points to that issue of complexity you mentioned. It's not enough to know a program exists. You have to know the rules, the nuances, the correct sequencing.
Get the timing wrong, and you might lose the benefit, or, even worse, get hit with a surprise tax bill.
That's precisely why we're here. And that brings us directly to our focus today, the First Home Savings Account, or FHSA.
We're calling this the FHSA Superpower.
And that's not hyperbole. It is, without a doubt, the most exciting and generous financial tool for young buyers that Canada has introduced in a generation. It is a game changer.
So our mission today is to give you that full strategy. We're going way beyond the basics. We're going to unpack the mechanics, clarify those really strict eligibility rules.
Especially the spousal trap.
Oh yeah, especially that. We'll detail advanced strategies like stacking and deduction deferral, and then, critically, connect saving the down payment with the absolute necessity of protecting that asset.
Because that's the part everyone forgets. The moment you get that house and that, enormous mortgage, your financial life changes complete.
Saving is just step one.
It's just step one. Long-term security requires protecting your income, protecting your family. If we only focus on the FHSA, we're building a beautiful house on a really shaky foundation.
And that is exactly where the idea of holistic financial planning comes in. It's the bigger picture.
Yeah.
We want to mention that there are firms that specialize in this, like Munis Financial Services.
Right. They're a leading firm in Vancouver, been around since 1995, and they really get that the FHSA is just the starting line. They help build the whole fortress.
So things like investment management, retirement planning, but also the protection pieces.
Exactly. The foundational stuff that gets overlooked in the excitement of buying a house, a proper legal will, the right insurance, life, disability, to make sure the whole structure is secure.
So we're building a fortress, not just a pile of cash. Let's start with the cornerstone of that fortress.
Yeah.
The FHSA Superpower itself.
Let's do it.
Let's jump into the core mechanics and what you call that unique dual taxed advantage.
The 1-2 tax punch.
I like that. When you look at other accounts, the RRSP, the TFSA, they usually give you one big tax benefit. The FHSA gives you both. Walk us through that.
Okay, so it's a hybrid. It's designed to take the best parts of both of those accounts. Punch 1 is the immediate benefit, and that comes from the RRSP playbook.
Okay.
Your contributions are tax deductible. So you're funding it with pre-tax dollars, which means you get an immediate tax refund for the year you contribute.
Which is huge when you're trying to scrape every dollar together for a down payment.
Yeah.
So that's Punch 1. What's Punch 2?
Punch 2 is the benefit you get down the road, and it's pure TFSA. When you make a qualifying withdrawal to buy your first home, both your original contributions and all the investment growth are completely 100% tax-free.
Wait, say that again. So if I put in $40,000 and it grows to $60,000, I got tax deductions on the 40, and then I pull out the full $60,000, and the CRA doesn't touch a penny of it.
Not a penny. That is precisely the magic. It is the only registered account in the Canadian tax code right now that gives you the deduction on the way in and tax-free growth on the way out. It is massive, massive leverage.
Okay, let's get into the hard numbers then. What are the limits? How much can people actually put away?
The rules are very clear, very rigid on this. The annual contribution limit is $8,000.
Okay.
And the lifetime maximum contribution is $40,000. It's a finite resource.
So that $8,000 annual limit, simple math says it takes a minimum of 5 years to max it out.
5 full years, yep.
Let's make that tax deduction tangible. You said you get a refund?
Yep.
Let's run a specific scenario.
Let's ground it. Let's say you're in British Columbia earning $100,000 a year, At that income, your combined marginal tax rate is roughly 38%.
And the marginal rate is key, right?
Yeah.
Because the deduction comes off your highest taxed income.
Yeah. Exactly. So when you contribute that max of $8,000, you're reducing your taxable income by $8,000. Since that money would have been taxed at 38%, you get 38% of it back.
Okay, so 38% of $8,000, that's an immediate refund of $3,040.
Cake in your pocket.
That's a guaranteed return on investment right there. You could use that refund to help fund next year's contribution.
It totally changes the math on saving. You get that instant cash injection from the refund, and then all the growth is tax-free. So if that $8,000 grows to, say, $12,000 over a few years, you pull out the full $12,000. That $4,000 in growth is just tax-free.
The tax just evaporates. Though, okay, so the money is in the account, it's sheltered. What can we invest it in? Are there any weird restrictions?
No, the flexibility is fantastic. It's just like an RRSP or a TFSA. You can hold cash, GICs, bonds, stocks, mutual funds, ETFs. You have the full toolkit.
But the strategy here has to be different, doesn't it? This isn't retirement money that has 30 years to grow. This is down payment money with a deadline.
That is the most critical point. If the market crashes a month before you close on a house, it could be absolutely devastating.
Catastrophic.
So if your timeline is short, say 3 to 5 years, your one and only priority is capital preservation. You cannot afford market risk.
So we're talking safe, liquid, stable stuff.
Exactly. High interest savings accounts, GICs that mature around when you want to buy, and those high-interest cash ETFs have become really essential tools here.
But things with tickers like TASH.TO or PSATO. For people who don't know that jargon, what are those?
Yeah, good question. They're basically like high-yield savings accounts that you can buy and sell on the stock market. They hold super secure short-term debt, so they don't have that stock market volatility.
And that reinforces your point from earlier.
Yeah.
The real return, the guaranteed return, is the 30 or 40% tax refund you get. Anything you earn from interest is just a bonus.
That's the mindset. You don't need to chase market growth. Now, if your timeline is long, 7 to 10 years plus, sure, growth-oriented ETFs are appropriate. Time is on your side.
But no matter where you start, you have to have what you call a glide path, right? You have to de-risk as you get closer.
It is mandatory. It's a systematic de-risking strategy. 10 years out, maybe you're 80% in stocks. But at 5 years out, you have to start shifting, maybe 50-50.
And in those last 2 or 3 years.
You should be 100% out of the market. 100% cash, cash equivalents, GICs. Failure to do that is the single biggest mistake a first-time buyer can make. You just can't risk it.
Okay, that's crystal clear. Let's get into some of the more advanced strategy now, comparing the FHSA to the other accounts to see where it fits.
Right, because you only have so many dollars to save, you have to prioritize.
Let's use 3 pillars: deduction, withdrawal, and room reinstatement. Let's start with the TFSA.
TFSA. No deduction going in, withdrawals are always tax-free, and, crucially, the room comes back the next year. It's your ultimate flexibility account.
Okay, the RRSP.
RRSP. You get the deduction now. Withdrawals are taxed as income almost always, and the room never comes back. It's for retirement.
And now the FHSA.
FHSA. You get the deduction now. Withdrawals are tax-free, but only for a qualifying home purchase. And like the RRSP, the room never comes back. That $40,000 limit is a one-time deal.
So when you stack them up like that, if you know you're buying a home in the next 15 years, the FHSA has to be priority number 1.
Absolutely. Which leads to our first advanced maneuver, deduction deferral.
Okay, explain this, because a lot of younger listeners are in the lower tax bracket now, but expect their income to go up.
This is a really powerful strategy. The FHSA lets you contribute now, but claim the deduction later.
How does that work?
So imagine you're 23, making, say, $45,000 a year. You're in a 25% tax bracket. You put your $8,000 in the FHSA to get that growth clock started. If you claim the deduction now, it's worth $2,000. But you know that by age 35, you'll be making $160,000 and you'll be in, say, a 45% bracket.
So you just wait.
You wait. You contribute today, but you defer claiming the deduction on your tax return. Then, when you're making that higher salary, the same $8,000 deduction is suddenly worth $3,600.
You've basically doubled the value of the tax break just by being patient. That's huge.
It requires some discipline, right? You have to track it.
You have to track it. On your tax return, you report that you made the contribution, but you specify you're not claiming the deduction. It creates a carry-forward amount, just like unused RSP room. The risk is forgetting you have it, but the payoff is massive.
Okay, now for the landmines. Let's talk about the biggest trap of all, eligibility.
This is where things can go wrong fast. The basic rules are Canadian resident, at least 18, and you have to be a first-time homebuyer.
And that definition of first-time homebuyer is where the spousal trap comes in. It is. The rule is you can't have lived in a home owned by you or your spouse or common law partner during the year you open the account or in the 4 calendar years before that.
Let's walk through an example. I'm single, I rent, I'm totally eligible. I meet a partner who owns a condo. We decide to move in together next month.
Okay.
If I move in and then I try to open my FHSA a year later, am I in trouble?
You are likely sunk. Once you become common law, you're considered to have lived in a home owned by your spouse, which makes you ineligible to open the account.
So what's the non-negotiable tip here?
You must open your FHSA before you move in together. Open the account, even with $50. That locks in your eligibility based on your status at that moment.
So once the account is open, I can move in with my partner, keep contributing, and I'm still good to go for a qualifying withdrawal down the line.
You are still good to go. It's a critical timing issue.
Okay. What about contributing as a couple? Can my partner give me money to put in my account?
Yes, and this is a great feature. Anyone can gift you cash, a partner, parents, and you contribute it to your FHSA and you claim the deduction. The normal income attribution rules don't apply.
So a family can work together to max out 2 accounts really quickly.
Very efficiently, yeah.
That urgency to open the account also connects to the carry-forward rules, which are pretty strict.
Very strict. Unlike a TFSA, where your room rolls over forever, unused FHSA room only carries forward for 1 year.
Which allows for what you call the $16,000 burst. Explain that.
Right. So say you open an account this year but put in 0. Next year, you have this year's $8,000 room plus the $8,000 that you carried forward.
So if I get a big bonus or something in that second year, I can contribute a full $16,000 in one shot.
Exactly. But if you wait a year to open the account, you lose that first year's $8,000 of room forever. It's gone. It underscores why every eligible person should open an account today, even with a tiny amount.
Last warning in this section. Non-residents. What's the rule about making a withdrawal if you're living abroad?
This is non-negotiable. To make a tax-free qualifying withdrawal, you must be a resident of Canada at the time you take the money out.
And if you're not?
It's a non-qualifying withdrawal. The whole amount becomes taxable income, and your bank has to charge withholding tax. It completely defeats the purpose of the account.
Okay, let's move on to stacking these tools together. We've established the FHSA is the top priority, but you can also use the homebuyers plan from your RRSP.
You can, but we have to be absolutely clear on the fundamental difference.
Which is?
Repayment. The FHSA money is a gift. It's yours, tax-free, no strings attached. The HBP is an interest-free loan you're taking from your own retirement savings.
And you have to pay that loan back. What's the schedule for that?
You have to start paying it back 2 years after you withdraw it, over a maximum of 15 years.
And if you miss a payment?
The amount you were supposed to repay gets added directly to your taxable income for that year. It's a penalty.
Okay, so FHSA first, HBP second, and with a clear understanding it's a debt. But the potential down payment a couple can raise this way is, well, it's huge.
It's astounding. Let's do the math. An eligible couple, fully maxing out both programs, they can get $40,000 each from their FHSAs, tax-free, that's $80,000.
And then?
$60,000 each from their RRSP is using the HBT, that's another $120,000.
So $200,000 for a down payment, plus any growth in the FHSAs, that's life-changing in a city like Vancouver or Toronto.
It's the difference between buying and not buying. Now, that leads to the riskiest, most technical strategy, the double deduction maneuver.
This sounds tricky. You're using the same money to get 2 tax deductions.
You are, but it comes with a huge warning. You're creating mandatory debt to your RRSP.
Okay, walk us through the 4 steps very carefully.
Step 1, contribute to your FHSA. Claim the deduction, get your first tax refund.
Got it.
Step 2, make a qualifying tax-free withdrawal from the FHSA. The cash is now back in your bank account. Step 3, immediately contribute that same cash into your RRSP, assuming you have the room. This generates a second tax deduction and a second refund.
2 deductions from the same initial pot of money. So what's step 4?
You have to wait 90 days. That's a strict HBP rule. After 90 days, you withdraw those funds from your RRSP using the homebuyers plan for the purchase.
It sounds like financial magic, but
Yeah.
what is the giant flashing red warning light here?
The warning is that you have just forced yourself into HBP debt. You now must repay that money to your RRSP over the next 15 years. You've essentially mortgaged your retirement for an immediate tax refund.
So if you have any income instability, this is a terrible idea.
A terrible idea. This is only for people with rock-solid, guaranteed rising incomes. The risk of future tax penalties from missed HBP payments is just too high for most people.
Okay, let's talk about the actual withdrawal process. The rules are meticulous, right?
Meticulous. Get it wrong, and the whole thing becomes taxable.
So let's run through the checklist. What's required for a qualifying withdrawal?
First, you have to be a Canadian resident when you take the money out. Second, you have to be a first-time buyer at that moment.
Third,
You need a written purchase agreement, and you must have it signed by October 1st of the year after you make the withdrawal. That deadline can sneak up on you.
so if I pull money in June 2025, I need a signed deal by October 1st, 2026.
Correct. Fourth, you have to intend to live in the home as your principal residence within a year. And finally, you have to fill out the right paperwork, Form RC 725.
And once you make that first withdrawal, the clock starts ticking on the account itself.
That's right. The FHSA has to be completely closed by December 31st of the next year. You have to zero it out.
Which brings us to the finite lifespan of the account. It's not permanent, it's a 15-year clock.
It is. The account must be closed on the earliest of 3 dates, the 15th anniversary of opening it.
Which is why you open it now to start that clock.
Exactly. Or the end of the year you turn 71,
Yeah.
or the year after your first qualifying withdrawal.
Now, for my favorite part of this whole thing, the benevolent failsafe. What happens if I save up 65 grand in my FHSA, but my plans change and I never buy a home? Is all that tax benefit wasted?
Not at all. This is the win-win scenario. You can transfer the entire balance, your contributions, plus all the growth directly into your RRSP.
And it's tax-free?
Completely tax-free. But here's the incredible part. That transfer does not use up any of your existing RRSP contribution room.
Whoa, hang on. So the FHSA effectively creates bonus RRSP room for you, equal to whatever the final balance is.
It is bonus retirement savings room. You got the deduction on the way in, enjoyed tax-free growth for up to 15 years, and then you just roll it into your retirement fund. It's an unbelievably efficient way to turbocharge your retirement savings if you don't end up buying.
That completely changes the risk profile. The worst-case scenario is you end up with a supercharged RRSP.
Exactly. The only thing to avoid is just taking the cash out. If you do that, the whole amount is taxed as income, and you'll face a massive tax bill. The RRSP transfer is the default smart choice.
Okay, this is the perfect pivot point. We've spent all this time talking about how to get the asset. Now we have to talk about how to keep it. This is where that holistic planning comes back in.
Right. Once you have that mortgage, your single most valuable asset is no longer the house. It's your income.
The engine that pays for everything.
You have to insure the engine. And that starts with disability insurance. The stats are stark. About 1 in 3 working Canadians will be off work for 90 days or more due to an accident or illness.
And the government safety net, CPP disability, just isn't enough to cover a mortgage in a major city.
Not even close. It averages about $1,000 a month. Private long-term disability insurance is essential. It's designed to replace 50 to 70% of your income, usually until age 65.
The second layer, if you have a partner or kids, is life insurance.
It's foundational. You need to make sure that if the worst happens, the mortgage gets paid off, and your family isn't burdened with that debt. Term insurance is usually the most cost-effective way to do that.
Okay, and the last piece of this protection puzzle is the will. So many young people put this off. Why is it so urgent for a new homeowner?
Because dying without a will, it's called dying intestate, creates immediate and devastating legal chaos.
What happens to the house?
The whole estate gets frozen. The legal process, probate, can take a year, even 2 years. During that time, your family can't sell the house, they can't manage the mortgage, they can't do anything, and provincial law decides who gets what, which might not be what you wanted.
You're turning a tragedy into a financial and administrative nightmare.
You are. And if you have kids, the will is the only place you legally name guardians for them. It's an immediate necessity.
So this whole discussion, FHSA, insurance, wills, it really highlights that you need an integrated plan.
You do. And that's exactly the focus of a firm like Moneris Financial Services. They've been doing this in Vancouver since 1995, serving clients across Canada. They understand that saving the down payment is just step one.
They help put that whole financial plan together, right? Investments, retirement, and the estate and protection planning we just talked about.
Yes. They handle the full range of solutions, from RRSPs and TFSAs to the critical insurance pieces like life, disability, and critical illness. They make sure all the parts are working together to build that financial fortress.
So for a listener who's feeling like, okay, I get the FHSA, but I need help with the rest, Muneris is a great resource.
For sure. You can reach out directly to Mansoor Khalili for customized solutions on life insurance, annuities, and investments.
Okay, so to connect, you can call or text Mansoor Khalili at 778-898-3202.
Or you can email him at mansour@muneris.com. That's MANSOUR at MUNERIS.com.
And their website has all their services, which is just muneris.com.
Yep, muneris.com.
Let's pivot to one final warning, the debt trap of the 30-year mortgage. It's so tempting right now to stretch out that amortization.
It's incredibly tempting. It can lower your monthly payment by hundreds of dollars and make it easier to pass the stress test. It feels like a win.
But the hidden cost is, well, it's staggering. Let's use that example of a $500,000 mortgage at 5%.
Okay. If you pay that over a standard 25 years, the total interest you'll pay is about $388,000.
A huge number, but that's the baseline. What happens if we stretch it to 30 years?
If you stretch it to 30, the total interest paid balloons to about $482,000.
Wow, so that's an extra $94,000 in interest?
Almost $100,000, just for that immediate monthly relief.
That's more than double the entire lifetime limit of your FHSA. You work for 5 years to save $40,000, only to give the bank an extra $94,000.
It completely reframes the decision, doesn't it?
It does. So for anyone who has to take the 30-year term just to get in the door, what's the mandatory aggressive off-ramp plan?
You have to treat that 30-year term as a temporary emergency measure. Your goal from day one is to get it back down to 25.
So step 1, lump sums.
Every extra dollar goes on the principal. That tax refund from your FHSA, straight onto the mortgage. Bonuses, gifts, all of it.
Step 2, the easiest and most powerful switch you can make.
Accelerated payments. Switch from monthly to accelerated bi-weekly or weekly. This simple change means you automatically make one extra full monthly payment per year. It shaves years off the loan without you even feeling it.
And step 3, be proactive at renewal.
Don't just auto-renew. When your term is up in 5 years, actively tell the bank you want to shorten the remaining amortization. If you started at 30, get it down to 25. Attack the principal relentlessly.
Okay, that was a really critical deep dive into the playbook for the FHSA and how to protect what you build.
To recap the big takeaways, the FHSA has that unique dual tax advantage. It is your #1 savings tool.
And your first action item is to open an account today. It locks in your eligibility and starts that crucial 15-year clock.
Remember to prioritize the FHSA over the HBP because it's non-repayable. And if you take a 30-year mortgage, you must have an aggressive plan to pay it down faster.
We've given you the knowledge. Now it's about turning that into action. We want you to commit to doing one single thing today to move forward.
Whether that's opening the FHSA, calling your bank to switch to accelerated payments, or starting the conversation about getting a will, just take one step.
And for those of you looking for that comprehensive, customized plan that integrates all these pieces, we encourage you to reach out to Muneris Financial Services.
You can connect directly with Mansoor Khalili by phone or text at 778-898-3202.
That's 778-898-3202. Or by email at mansour@muneris.com.
And you can find them online at muneris.com.
We hope this deep dive helps you shift from just learning to actively planning. We'll see you next time.